Hey guys, in today's video we will check out top 5 Vanguard ETFs which you want to invest into and then forget about the stock market and checking the prices and checking where the market goes up or down. You will keep buying that stock forever until you retire. And this is the perfect situation and I suggest you to get straight into it. So, before we select ETF for the long-term period, I want to make sure we will understand what are the decisions we make before we select that ETF, what it will be based upon. And I want you to take a look at this table, which represents asset classes returns for the past 15 years. And if we take a look at the bottom here, it will show that large cap stocks, which represent index S&P 500, has annual return of 9.88%, which is the highest percentage out of all other asset classes that we have here. And we also have small cap stocks, we have international stock, we have emerging market rates, high grade bonds, and high yield bonds or junk bonds. We have cash and portfolio, which will consist of small bits of all of these above. But the main thing we have here is that large cap stocks outperforming everything else. This is the first thing we have to keep in mind. And the second table I want you to take a look at, so that we know why we are choosing definite indexes and ETFs. And this is S&P 500 performance over past 15 years. And if we take a look at the same thing here on the bottom, then annual average return of different sectors, we can realize that informational technology or IT sector outperforms everything else with 15.21% on the average per year for the past 15 years. It's quite a long-term period. And we can see that there are also some other sectors like consumer discretionary and consumer staples, and as well healthcare, showing quite good performance. What does it mean? I want you to understand that we don't want our ETF consist only of that sectors, but we want our ETF to have more accent on those sectors and have them a little bit more percentage than the others. And that will suffice for us to benefit slightly more from what we have amongst all the varieties of the ETFs that Vanguard offers to us. So we're keeping these two things in mind, that we want our ETF to consist of large cap stocks, large cap US stocks, and having IT sector and consumer discretionary and consumer staples, and maybe healthcare sectors to be with a little bit more percentage. We can proceed now selecting the ETFs. So right now we're on the Vanguard page, and the ETF which I suggest you to buy is Vanguard S&P 500 ETF. And it may look simple and even boring, but this is exactly what we checked on the previous tables, because S&P 500 ETF consists of exactly large cap stocks that we want. It is widely diversified, we'll check later it, and it has emphasis on that sectors that we want. Let's check it out. So, the expense ratio for this ETF is 0.03%. VOO is the ticker symbol for this ETF, and it tracks the S&P 500 index, representing 500 of the largest US companies, and this is exactly what we want. So, going down, we can see the performance of this index over past 10 years on the average was 16.5% per year. And here is a hypothetical growth of $10,000. If we would invest it 10 years before, by now it would be around $40,000, pretty good. And so basically, of course, it consists of 500 companies. Here are top 10 largest holdings, and these are the biggest companies we all know, like Apple, Google, Amazon, Tesla, here and there. And these top holdings represent almost 30% of total net assets of this index. And main thing here is portfolio composition. We want to make sure that it consists of IT sector, of consumers, and of healthcare. This is exactly what we want for our portfolio to grow, which is proven for the past performance from the tables what we've seen in the beginning of this video. So we can see that IT sector represents 28%. Perfect. Not too much, not too less. Exactly what we want. Then consumers are 10% and 12% roughly, and healthcare is 13%. I think you understand why I mentioned this ETF first one. And if I had only one ETF to show you here in this video, this would be S&P 500 index. And I should tell you that Warren Buffett, who was writing in his letter to the shareholders and to his family and to his wife that they should invest 90% of their money into S&P 500 index. And I can understand him. There is a basis for their thoughts, there is a grounding for that explanation. And we can understand now why. So S&P 500 index, we understood that. And the next ETFs actually on this video will be based around this idea that we need large cap stocks and with strong emphasis on certain sectors. So we finished with VOO, Vanguard S&P 500 ETF, and we go to the next one, which is VTI, Vanguard Total Stock Market ETF. So what is the difference between Vanguard S&P 500 and Total Stock? The Total Stock Market ETF, which is VTI, consists not only of large cap stocks, but also includes mid cap stocks and small cap stocks. And there is a grain of good idea because it increases diversification. So this is kind of S&P 500, but a little bit more safer because of the diversification our assets among different cap stocks. And if we take a look at the expense ratio, this is exactly the same, and the lowest on the market, 0.03%. Quite good for us. So if we take a look at the performance of this ETF for past 10 years, it's 16.3. Fair enough, and quite close to what we've seen in ETF 500. It was 16.5, almost the same thing. And the hypothetical growth of such ETF would be pretty much the same what we've seen with ETF 500 for S&P 500, but a little bit less because you can see that performance of it is a little bit less, but it has more diversification. We can see that number of stocks in this ETF has grown from 500 to 4,000. So 3,500 companies more in this ETF. And what is funny here, that if we take a look of net assets of 10 largest holdings here, it's 25. And if you remember in Vanguard S&P 500 ETF, it was 30%. 25 versus 30%. So by adding 3,500 stocks, our top 10 holdings reduced only by 5%. And what does it mean? It means that our large cap stocks still have a pretty big influence on the total price of our portfolio, and the changes in price of the bigger companies will have more effect on our portfolio. And this is actually quite a good idea for us if we want to make a little bit more of diversification and to be on the safe side. And one more thing I want to show you again, if we come back to our tables with sectors now, if we go to the asset returns, then we can see here that the large cap stocks for the past 15 years had average returns of 9.88%, but at the same time small cap stocks had return of 8.91. Not that less, and actually the second result amongst all the assets that we have in this table. And if we go further in the past, I actually have to tell you that small cap stocks actually outperformed large cap stocks. But that was in the past, and we can see that things actually may change. And at this moment, large cap stocks actually outperforming. And that is why, that's one of the reasons why I'm showing to you this VTI Total Stock Index. ETF because it includes different sizes of the companies. And if things will change even more, maybe mid-cap stocks will be showing better performance, then we already have them in our portfolio. And we're a little bit on the safer side. And for those of you who might be worried about their investments and want to be on the safer side, I would recommend this ETF. So the third ETF for today will be Vanguard Growth ETF with ticker symbol VUG. Now, the second one was the more safer way of the Vanguard S&P 500, and this one is more riskier but showing higher returns. Take a look at this. Now, this ETF as well consists of large cap stocks, the same as S&P 500. So expense ratio is a little bit higher, it's 0.04%, and if we take a look at the performance for the past 10 years, now I want to highlight that this is average performance, means it already includes the worst case scenarios and the best case scenarios that have been in the previous 10 years. So this is exactly what we want, average annual return. An average annual return for this ETF is 19.3%, crazy numbers, versus 16 point something for ETF S&P 500. And our $10,000 would turn into $45,000 with this VUG ETF instead of $40,000 with VOO, which was the first one. But why I consider this ETF more riskier than the first two is because if we take a look at the number of stocks, it's only 265. And if we take a look at the percentage of top 10 largest holdings in this ETF, it will be 50%, the half. The half of the ETF will represent the same companies that we've seen in the S&P 500 and in the total stock market, but they have very big influence. And if one of them will suddenly drop down, it will be more influential for us. And if we take a look even more of portfolio composition breakdown among sectors, then technology will represent 50%, the half of this ETF, which is not good for our diversification. And another quarter will be for consumer discretionary. Of course, I mentioned in the beginning that we want our portfolio to consist a little bit more of IT and consumers, but not that more. So for example, in my personal portfolio, I don't want to get rid totally of all other sectors. I still want to keep them. And this is basically the idea of diversification. And if I buy this ETF, I will probably have higher returns for the next 3-5 years, and then later I will check whether I want to keep it or not. But my patience will be gone because I will have to constantly check the markets and see if it is outperforming the S&P 500. And if it is not, then I'll be worried and sleep badly at nights. And I have to still keep checking the market with this ETF. So be careful if you want to take this one, but the history shows that for the past 10 years at least, it's showing better results. And the interesting thing here, that if we take a look at the returns of this ETF since inception, since 2004, then the returns are 12%. Remember, 12. And if we compare it to the S&P 500 ETF, the returns of that are 16%. So that is why I'm showing that for a short-term period, VUG ETF may be more profitable, and it actually is. But diversification here is not followed. Alright, so far we've been talking about ETFs consisting only of the assets on the US stock market. And that is why ETF number 4 I want to show you today is ETF for Vanguard Total International Stock, VXUS. So this ETF tracks performance of the stocks outside the US. And this ETF has not only large cap stocks, but actually all cap stocks, including mid cap stocks and small cap stocks, which is kinda better for our diversification. So if we go ahead and check, the expense ratio for this ETF is a little bit higher, 0.07% each year. And we see here that the risk potential here is listed as 5 and previously we had only 4s. And the performance of such ETF is 7.7% annually on the average for the past 10 years. And as we can see, the performance of such ETF is less than, for example, S&P 500. So what I'm gonna say now is we don't want to keep our full investment portfolio in this international ETF, but instead we wanna make some part, let's say 10% of our portfolio, to put in the international stock market, so that if there is by any chance, for example, at the moment US is the strongest economy in the world, yes, but as Ray Dalio as well says in his latest video, that each empire has its own time for a rise and its own time for fall, and everything good sometimes ends up, and there may be a chance that China will soon become even more stronger economy than the US, and we want to make sure that we will catch up that strain if that is the case. So we can see that the number of stocks in this ETF is 7,700 stocks, pretty a lot, and we can see that it pretty much diversified, because top 10 largest holding will have only 9.5% of this ETF, so it's diversified and it's international, and it may be good for our portfolio to have a piece of that inside our portfolio. Alright, so far I showed to you 4 ETFs, and that consisted of different stocks, large cap, small cap, US stocks and international stocks. For the last one, for the 5th, I want to do something special and show to you some really cool stuff, which actually going against the main idea of this video, to buy the ETF and hold it until retirement, but maybe some of you guys will be interested in this cool feature. Well, I'm not saying it to apply for everyone, but those of you who want to get the best performance of your portfolio may take a look at this strategy that I'm gonna show you right now. So the last one is actually not a single ETF. It will be 11 different ETFs, and 11 because there are 11 sectors in the economy total. So each of these ETFs will represent one single sector. And why I'm showing this to you is that some of you may know or may not know there are business cycles and they're going up and down. And for example, at the moment US is on the mid-cycle of the economy. And there are some sectors which are feeling better on this mid-cycle of the economy. If we take a look at this table, then we can see that on the mid, pretty much most of the sectors are feeling bad except technology and communicational services. And I think you're starting to understand me what I mean by this. When we know that US stock market is on the mid-cycle and technology sector and communication services are feeling better and outperforming the market during these times, maybe we want to keep, well, at least not all of our portfolio, but to let some part of our portfolio be in these two sectors and buying these two ETFs for them. And what we need to do is to keep buying sectors which are good for present economical cycle and selling that are already not good, and holding them according to the business cycles. So for example, US economy currently on the mid and entering late cycle. We want to keep these two sectors like technology and communicational service in our portfolio, but later when we will enter late cycle, we want to keep some of these sectors which will highly outperform the market, like materials or consumer staples or maybe healthcare. And why I'm showing this to you? Because there is a study showing what are the benefits of such sector investing. Take a look at this graph. So here is buy and hold strategy, which is blue, is simply keeping all the S&P sectors, buying S&P and holding it. Top 1, top 2 and top 3 here will represent how many sectors we'll keep simultaneously at the same time. So top 1 means that we'll keep one best sector during one time and then sell it and buy the new one when the next cycle comes. Top 2 means that you'll have 2 sectors simultaneously, and top 3 means that you'll have 3 sectors simultaneously. So according to this graph, and especially on the long term, this sectoral investing strategy will highly outperform the S&P 500, as you can see here. And I know this is not for everybody, but I know as well that there are some guys who might be interested in such sectoral investing, who might want better performance of their portfolio. And maybe not all portfolio, as I told you, but some part of it may be invested in such quite kinda risky and interesting way. And where you can keep track of such economical cycle, either you can do it yourself to analyze the market, which I can show to you in the next videos if you would like to, or you can just simply go to any of the rating agencies or websites, like for example this one is Fidelity, and this table is completely free, which I'm showing to you. Alright guys, I actually showed to you not 5 but a little bit more ETFs, but you've got the idea. And the main thing for this video for today, I'll repeat it again. The bad thing for us for today is to keep and buy large cap US stocks, preferably with emphasis to IT sector, consumer discretionary, consumer staples, and healthcare sector, and keep it for a long period of time. And if you don't wanna make additional moves here and there, then the bad thing for you may be simply buying S&P 500 ETF, which is VOO. I hope this video was useful. You got some idea which ETF you wanna buy. Please like this video, put any comments if you have questions, and if you don't have questions, also comment this video. I'll appreciate. I'll try to improve my English. Thank you for watching. Cheers!